first person to make a clear distinction between active and passive investing was the American economist and financial analyst Benjamin Graham. Born in London in 1894, his parents moved to the States when he was a baby. He studied and taught at Columbia University and co-founded a highly successful investment company. His books have become investing classics. Graham described active investors as speculators. They need to be interested in studying companies and markets and have the time to do it. Ideally, they'll have specialist knowledge as well. Passive investors, on the other hand, are essentially defensive and in it for the long term. Graham recommended that passive investors have a diversified portfolio split between shares and bonds, which they occasionally rebalance. One of Graham's students was Warren Buffett, who once described him as his idol. Like his mentor, Buffett is, of course, a speculator, but he too recommends passive investing for the majority of investors. Most investors, he once said, will find that the best way to own shares is through an index fund that charges minimal fees. Those following this path are sure to beat the net results of the great majority of investment professionals. But without doubt, the most important figure by far in the development of passive investing is this man, John Bogle. In a thesis he wrote as a student at Princeton in 1951, Bogle highlighted the conflict between a fund manager's loyalty to himself and his duty to the investor. 2 decades later, he founded a company on the biblical principle that you cannot serve two masters.
Mutual funds are there to serve not the manager, but the shareholder. So our idea was to have a mutual firm in which the shares of the manager are owned by the funds themselves.
His whole firm, Vanguard, that he built, has simply placed clients at the center of everything that they do. They're a mutual company and therefore aren't out with a massive profit motive. There's pretty little trust in this whole business, and I think that deep trust that people felt in his message was very powerful.
Bogle realised that most people are investors rather than speculators. By investing in low-cost index funds and settling for the average market return, they almost invariably end up better off than those who pay an active fund manager to speculate on their behalf.
Jack, more than anyone else, kept a very simple view in articulating why people need to think about cost. So you get risk, return, and cost. That's the triad, the trinity, for thinking about investing. And Jack emphasized the fact that higher cost investing is the real downfall of most investors.
It's as simple as this. Gross return in the financial markets minus the cost of playing the game is the net return all investors divide up. So it's the relentless rules of humble arithmetic.
For a long time he was ridiculed and poo-pooed. People were saying things like, it's un-American to own a passive fund. Surely an American's duty is to beat the market. And I think he has a bit of a laugh about that now.
People said, why would anybody settle for average? Would you want an average surgeon? No, I wouldn't. Would you want the market average? Yes, I would. There's a big difference between those two things. And think of how times have changed today.
Indeed they have. American investors have poured nearly $2.5 trillion into index funds, and Vanguard is now the biggest investment company in the world. A monumental achievement for the man who championed investing over speculating.